Open your banking app in your head and scroll to the recurring payments. Somewhere on that list sits a line that reads something like life insurance, with a number next to it that used to feel small. It doesn't feel small anymore. Rent went up, groceries went up. That premium barely moved, and yet it still feels like the easiest thing on the list to cut. Everything else on that list comes with a consequence you can picture immediately. Miss the mortgage, lose the house. This one doesn't come with an obvious consequence, which is exactly why it's usually the first thing people reach for. This year, your thumb has actually hovered over the word cancel. You are far from the only one. Millions of people did more than hover, they tapped it. And almost none of them checked the one number that decides whether that tap saves money or quietly becomes the most expensive decision they make all year. What is that number? Before you tap anything, it's worth 6 minutes to find out. Here's what almost never gets explained clearly. Canceling a policy isn't one thing. It can go two very different directions, and insurance companies rarely walk you through both in the same conversation. Stop paying a policy that never built up savings, like most term insurance, and after a grace period of about 30 days, it simply lapses. If something happens to you during that 30-day window, the death benefit typically still gets paid, minus whatever premium was overdue. It's only once the grace period fully closes that the protection actually disappears, with nothing to collect. Stop paying a policy that has built up real cash value over the years, and that's not a lapse. That's a surrender. Asking the company to pay out what's inside the policy before it closes the account for good. Same word, canceling, in everyday conversation. Two completely different financial events. Which one applies to you? Here's the number nobody sees on their own statement. The American Council of Life Insurers, the industry's own trade group, tracks exactly how much coverage gets walked away from every year. And its latest published figures cover 2024. Voluntary terminations of individual life insurance, lapses and surrenders combined, hit 5.8% of all the coverage in force that year. That's the highest that figure has been in the 11 years of data the group has published. Measured a different way, by the number of policies instead of their dollar value, 2024's individual lapse rate came in at 6.6%, actually a slight improvement from 2023's 7.3%, itself the highest point in that same 11-year stretch. However it gets measured, the direction hasn't been down. How does a single percentage turn into a real number? 5.8% of $14.1 trillion in individual coverage works out to roughly $816 billion in protection Americans gave up in a single year. Put that next to the average size of a new policy bought that same year, $209,000, and it means something close to 3.9 million average families' worth of protection disappeared in 12 months. Not because anyone died, because someone, somewhere, hovered over the same button and tapped it. Why now specifically? Nobody at that trade group writes the word inflation next to their own chart. But look at the shape of it anyway. The lapse rate sat at 3.7% in 2021 and has climbed every year since, 3 years straight, to 4.7% in 2024. 3 years of rent, groceries, and interest rates doing exactly what premiums mostly didn't do, getting more expensive faster than paychecks kept up. That's not proof that grocery bills are canceling policies by themselves, but it's a pattern that lines up a little too neatly to ignore. Before this goes further, there's a short, free checklist built around exactly the 4 questions this video is about to walk through, sitting in the pinned comment for anyone who wants it before they touch that cancel button, not after. Here's the twist almost nobody runs the numbers on. The plan to just buy it back later when things are better. It sounds harmless, right? But life insurance pricing doesn't agree. Every year you age, the math resets against you, and the price shoots up faster than you think. Take the 2026 market average rate chart published by Ramsey Solutions. Attention, this is based on broad 2026 market averages across insurers, not a quote or proposal from any one specific company. So treat it as a market trend, not a personal promise. For a healthy man buying $500,000 of 20-year term coverage, the going rate around age 30 is about $18 a month. At 40, roughly $28. At 50, it jumps to $69. At 60, it gets close to $200 a month. For the exact same amount of coverage, sit with just the middle of that for a second. Someone who cancels a policy at 40 to save that $28 a month, then decides to buy equivalent coverage back 10 years later at 50, isn't paying just a little more. They're paying about 146% more. And that's the most optimistic scenario, assuming their health hasn't changed at all in that decade, and they still qualify for the best pricing available. Multiply that difference across a new 20-year policy, and it adds up to over $9,800 extra compared to what simply staying put would have cost. Subtract every dollar saved by skipping premiums during those 10 uninsured years, and the household still comes out roughly $6,400 worse off in premium dollars alone. That's before counting 10 years with no coverage at all. It's before counting what happens if the health exam 10 years from now doesn't go as smoothly as it would today. There's also a door in between fully paying and fully canceling that most people never get shown, because the person on the other end of the phone has no reason to offer it first. Many insurers will let a policyholder reduce the face amount instead of ending the policy outright, dropping $500,000 of coverage down to $250,000, for instance, and lowering the premium proportionally without losing the policy, its original start date, or having to prove medical insurability all over again. It doesn't erase the bill. It cuts it in half on a policy that's already proven itself, instead of walking away from the whole thing to try to save the same amount somewhere else. That's the story for a policy with no cash value sitting inside it. A different policy with a different hidden option tells a different story. If you've been paying premiums for years into a whole life or universal life policy, there's usually real money built up inside it, the cash value. Surrender that policy and the company sends you a check for whatever's inside, minus taxes owed on the growth. The IRS treats any amount above what was actually paid in premiums as ordinary income, the same tax category as your paycheck, not as a capital gain or a gift. Most people accept that surrender check as the only offer on the table. What if it isn't? For policyholders who meet strict age or health criteria, and let me reinforce that this option is not for a healthy 30-year-old with a brand new policy. It's mainly available to people generally over 65 or anyone who's had a significant health change since the policy was issued. There's a second buyer in this market entirely, a life settlement. Instead of surrendering the policy back to the company that issued it, the policy gets sold on the open market to an investor willing to take over paying the future premiums in exchange for the eventual death benefit. According to transaction data reported by the Life Insurance Settlement Association, life settlements closed in 2023 paid an average of about 6 times the cash surrender value the insurer was offering. The broader range cited across the industry runs from roughly 4 to 7 times, depending on age, health, and policy size. Again, this is an industry historical average, not a guarantee for your individual case. But for someone who qualifies, $20,000 offered as a surrender value by the insurance company can mean $80,000 to $140,000 on the settlement market. Most families never hear that second number because the only offer they're shown comes from the company that benefits from them never asking. And for anyone watching this after the fact, because a policy already lapsed last month or last year, there's usually still a door back in. Most insurers hold a reinstatement window open for 3 to 5 years after a policy lapses. Walking back through it means paying every premium that you missed, plus interest that typically runs 6 to 8% a year, and proving your eligibility again. A short questionnaire if the gap was under about 6 months, or a full medical exam if it's been longer. This also quietly resets the insurer's 2-year contestability period from scratch. None of that makes reinstating free, it just makes it possible, which is more than most people realize once a policy has already lapsed. None of this means canceling is always the wrong move. Kids grow up, mortgages get paid off. Coverage that made sense at 35 doesn't always make sense at 60. And sometimes the honest answer is that the policy has simply done its job. Sometimes the premium really is the better use of that money right now, this month, for that family. This isn't a video telling anyone never to cancel a policy. It's a video about not doing it blind. So before that thumb lands on cancel, 4 questions belong on the kitchen table first, not in a phone call with someone whose job is to get your fastest possible yes. First, is this policy actually lapsing with nothing to collect, or is there cash value being surrendered? Second, has anyone asked about reducing the coverage amount instead of ending it completely, knowing that many companies allow a policy to shrink at a lower premium without starting over from zero? Third, if there's real cash value involved and you meet the criteria, has a life settlement actually been ruled out or just never been mentioned? And fourth, if the plan is to buy new coverage later, what would that same coverage cost at the age it'll actually get bought? Not today's age, the one 10 years from now. The banking app is still open. Your thumb is still hovering over the same word it was at the start. Nothing about the premium changed in the last 6 minutes. What changed is what that tap actually means. The number that mattered was never the one printed on your monthly statement. It's the number nobody shows you until after you hit the button.